Now, without further ado, let me introduce you to our first keynote speaker, Mr. Govind Gurnani, former Assistant General Manager, Reserve Bank of India. Mr. Gurnani is a distinguished banking veteran. He has over 35 years of invaluable experience from his dedicated services at the RBI, the nation's banking regulator. Academically accomplished, Mr. Gurnani holds an MBA in Banking and Finance and is a certified associate of the Indian Institute of Bankers. During his tenure at the RBI, he worked closely with esteemed RBI governors, including Dr. Bimal Jalan and Dr. Y.V. Reddy, on various critical assignments. His extensive work in banking supervision, which involved inspection of both public and private sector banks, has provided him with deep insights into the intricacies of financial oversight. Mr. Gurnani's core area of expertise include finance, monetary policy, banking audit, and corporate risk management. To top it off, he is a prolific writer also. He is regularly contributing columns to various banking and financial publications. He is also a prominent voice on LinkedIn, where over 50K followers engage with his immense banking knowledge. His rich experience and profound understanding of the banking sector's regulatory landscape make him uniquely qualified to share insights on the crucial topic of prevention and detection of corporate fraud in banking sector. Sir, we are all eager to hear your insights on the same.
Thanks for the nice introduction and good morning, everyone. At the outset, I congratulate FINCON Organizing Committee for arranging such a timely and meaningful conference on the international financial security and management, and thank them for inviting me to share my thoughts on prevention and detection of corporate frauds in the banking sector. This is a subject that is increasingly gaining momentum in the banking sector of India in the recent times. In the last 3 decades, Indian banking sector has witnessed several high-profile corporate frauds that expose serious gaps in its supervision and risk management practices. Such frauds not only impact the financial stability of individual banks, but also pose a wider threat to the integrity of the financial system. If the frauds are not prevented and timely detected, it leads to the reputational risk for the banks, undermines customers' trust in the banking system, and also destabilizes market. Now, since you are the students of forensic science, I have one question for you, that is, please raise your hand if you have watched the Scam 1992 Harshad Mehta story or the Bad Boy Billionaires. Well, great. A lot of you have seen these 2 films, that is Scam 1992 and Harshad Mehta story, or Bad Boy Billionaires. Okay. Now let us understand the gravity of this subject. As per the Reserve Bank's latest annual report, an analysis of fraud cases over the past 3 years has shown that the private sector banks have recorded the highest number of fraud incidents, whereas the public sector banks accounted for the largest share of the total fraud amount. Most frauds took place in the digital payment channels, such as credit cards and internet banking. The total number of fraud cases had gone down from 36,000 in FY24 to 24,000 in FY25. That means a reduction of 12,000 cases in this year, in the FY25. Whereas the total value of the frauds has jumped from 12,200 crore in FY24 to 36,000 crore in FY25. So amount-wise, it has increased 3 times than the FY24. Now, the private sector banks accounted for nearly 60% of the total fraud cases, reporting 14,000 incidents out of 24,000, whereas, however, it was the public sector banks that saw the highest monetary impact, with frauds amounting to rupees 25,000 crore, that is staggering 70% of the total amount of across all banks. I have worked for Reserve Bank of India for 34 years, and during my tenure, I had an opportunity to inspect a number of scheduled commercial banks as well as cooperative banks, and that helped me a lot to understand the modus operandi used in the corporate frauds, or simply how are the corporate frauds taking place in the banking sector. Now, I have one question for you, whether the corporate fraud is an organized crime or unorganized crime. What is your thought? Organized. Okay, great. And whether it is a criminal offense or the civil offense? Hmm? Who says? It is a criminal offense or the civil offense? Civil offense? No. Sometimes it is also a criminal offense. Here you have to see the intention. If the intention is wrong, intention is to divert the money, then it becomes the criminal offense. In the court, it is they have to prove it that the intention was wrong. They have diverted the money. They have not used that money for the required purpose. So if the intention is wrong, then it becomes the criminal offense and they have to go into the jail. Otherwise, recover the damages, whatever the loss that has happened. So now what is the modus operandi that the corporates are using for doing the frauds in the banking sector? The first route is the asset misappropriation. That is, asset misappropriation is done through the diversion of funds. Companies secure large loans from the banks or for the specific projects, but then divert these funds to the unrelated personal ventures, shell companies, or offshore accounts. So for specific, they are not using the money for the specific project, but they are diverting the money. And this becomes the criminal offense. This can involve creating a fake invoices or using the connected entities to route the money. So criminal offense होता है सेक्शन 405 ऑफ द आईपीसी में क्रिमिनल लाइबिलिटी वो मानी जाती है, अदरवाइज सिविल लाइबिलिटी होती है. The second route in the corporate fraud is using the forged or the fabricated financial statements. Borrowers present manipulated financial statements to the banks to secure the larger loans. Then they are legitimately eligible for. This includes inflating revenues, overstating assets, understating the expenses, or hiding liabilities. So how they are manipulating the statement? Either they will inflate the revenues, either they will overstate the assets, or they will understate their expenses, or hiding the liabilities. These are the four ways through which they can do the forged fabricated financial statements. And for this, the Satyam Computer Scam 2009, in this its founder Ramalinga Raju had manipulated the accounts by inflating profits by over 7,000 crore, leading to the governance overhaul in the IT companies. The third route used in the frauds is through the collusion with the bank officials. Here, corporates bribe the bank officials to get their loan sanctioned without proper due diligence or without proper checking. Corporates also take support from their auditors and rating agencies for carrying out the frauds in banks. Banks, on their part, try to delay in reporting such frauds to the law enforcement agencies and RBI until it becomes public. For example, the ILNFS, in infrastructure leasing and financial services, they have taken the support of the rating agencies as well as the auditors for doing the frauds in the banks. The fourth route is the borrowing from the multiple banks and the financial institutions. So companies obtain credit facilities from a consortium of banks or the multiple individual banks, often without disclosing their full debt exposure to each lender. These funds from one bank are used to repay the another bank's debt, creating a circular flow of money to delay the detection or their financial distress. So these are the four ways through which the corporates are doing the fraud. First is the asset misappropriation. Second is using forged or fabricated financial statement. Third is in collusion with the bank officials. And fourth is borrowing from the multiple banks or the financial institutions. Now, what are the factors that lead to the corporate frauds in the banking sector? In analysis of the corporate frauds in banking during last 3 decades has shown that the corporate frauds are driven by the combination of factors such as weak internal controls, lack of due diligence in credit appraisal, lack of effective post-sanction credit monitoring, concentration of advances in any one sector, lack of advanced technology to detect frauds, lack of proper internal audit, and information inconsistency. In cooperative banks, we find the lack of corporate governance, that is board governance, and last is the slow judicial process system to deal with the corporate fraud cases. And when the audit is taking place in the banking, they are examining the fraud from three angles, that is from opportunity angle, from the incentive or the pressure angle, or third is the rationalization. From these three angles, the auditing is taken place in the banker as well as in the corporates, that what was the intention behind doing the frauds, whether it was an opportunity with weak internal control is there, or whether it was a pressure for the employee to do the fraud, or their rationalization, how they are rationalized the fraud. Now let us discuss the changing landscape of the fraud prevention and detection before and after advent of advanced technology. First, we are taking the before the advent of advanced technology. Before the advent of advanced technology tools, corporate fraud prevention and detection in banks was manual and rule-based and relied on the bank staff to review the transaction patterns. Fraud detection was primarily based on the customer complaints, manual verification, and retrospective analysis. Regular audits and inspections were conducted to identify the fraudulent activities, which often led to the delayed detection. Banks were reporting fraud cases to the RBI and law enforcement agencies only after proper investigation, often leading to the long gap between fraud detection and fraud reporting. For example, the Harshad Mehta scam of 1992 and the Ketan Parekh scam of 2001. Due to the manual oversight and the lack of real-time monitoring, we show the stock market manipulation by the Harshad Mehta and Ketan Parekh, who were the famous brokers in the Indian stock market. This scam had gone undetected for years together, causing significant losses to the number of banks. Another example is the Punjab National Bank scam of 2018 involving Nirav Modi and Mehul Choksi of the Gitanjali Group. In this scam, fraudulent letter of undertakings worth rupees 11,400 crore issued by the PNB went undetected for years due to the lack of real-time fraud monitoring system. So this was the position before the advent of advanced technology. Now we will go through the position latest. So now the banks have started using the biometrics for authentication of transaction in real time. Banks also engage in the behavioral analytics for analyzing patterns, trends, anomalies in human behavior. In addition, banks use data analytics and machine learning for detecting the inconsistency. Banks are now shifting from traditional rule-based system to the AI-driven predictive analytics for early fraud detection. AI models quickly predict fraud trends by analyzing the fraud patterns and the market behavior. Here I will share the two recent examples. In 2020, the RBI's early warning signal systems helped it to flag the high-risk loans in the Yes Bank and the Diwan Housing Finance Limited. Yes Bank was a private sector bank, whereas DHFL, Diwan Housing Finance Limited, was the NBFC. In these two institutions, there were high-risk loans. They have extended to the real estate sector, and this helped the RBI to detect the financial stress in these two institutions before it turned to the crisis. And now how it is resolved. Yes Bank was revived within 15 days through a combination of strategies, including capital infusion, restructuring, and change in leadership. Funds were raised through a consortium of investors, including SBI and other commercial banks, for infusion of the fresh capital, whereas DHFL was taken over by the Piramal Capital and Housing Finance Limited within 2 years after it was referred to the NCLT for corporate insolvency resolution process. So these two institutions were revived quickly, one in within 15 days and one in within 2 years. The second example which I am giving for is the New India Cooperative Bank. It was failed due to the internal fraud of 122 crores recently, just 6 months ago. And this bank issue was resolved quickly by the Reserve Bank's timely intervention by merging it with the Saraswat Cooperative Bank now. So within 6 months, it was revived immediately. Now, before I discuss the fraud prevention and detection methods, let me first explain to you the basic difference between fraud prevention and fraud detection. Fraud prevention means taking proactive measures by the banks to stop frauds before they occur, while fraud detection refers to the process of identifying and addressing the frauds that are likely to occur or that have already taken place in the banks. Fraud detection means the ability to monitor all transaction payments in such a way that help it in detecting the suspicious transaction in real time. Goal of fraud prevention is to reduce the risk of future frauds, whereas the goal of the fraud detection is to mitigate the fraud. Hence, fraud prevention is a proactive and fraud detection is a reactive in the nature. Now I am going to talk about the 8 initiatives that the bank should take for the corporate fraud prevention and detection. Banks need to undertake following initiatives for the prevention and detection of the corporate frauds. First, banks must implement 3 types of controls, that is preventive, detective and corrective. Under preventive controls, the bank should conduct regular training program to educate their employees on fraud prevention and detection and should enhance KYC procedures and establish robust internal controls such as segregation of duties, dual authorization, that is 4 eyes principle should be there, and regular reconciliation processes. Under detective controls, the bank should leverage advanced analytics and machine learning algorithms for real-time transaction monitoring. Under corrective controls, the bank should develop clear procedures for investigating the suspected fraud cases. It should implement a zero-tolerance policy for the fraud. So, first measure that the bank should take is the preventive, detective, and the corrective control they should take. Second, the bank should have board-approved comprehensive fraud risk management policy, clearly identifying the roles and responsibilities. It should form a dedicated fraud risk management committee with cross-functional representation, that is representation from all departments which are critical in the banks, to oversee the implementation and effectiveness of the FRM policy. Third, the banks must conduct regular fraud risk assessments to identify and evaluate fraud risk specific to the organization. It should develop a fraud risk map to prioritize high-risk areas. It should develop a policy on engagement of external auditors for this. Fourth is the monitoring and reporting. Banks should monitor the fraud risk and indicators, that is early warning system framework, at the regular intervals and should regularly review and update the FRM policy. Banks should develop regulatory reporting mechanisms for frauds to the board, senior management, law enforcement agencies, and RBI about the fraud incidents and mitigation efforts. Fifth is the leveraging advanced analytics and technology and its integration with the fraud management system. Banks should invest in the advanced technologies, that is AI and machine learning, quantum computing, for real-time fraud detection and analytics. Banks should integrate fraud prevention systems with their customer relationship management and the transaction monitoring systems and the core banking to gain a comprehensive view of the customer activities. Sixth is the fostering a culture of integrity and transparency. Banks should encourage employees to report the suspicious activities without a fear of retaliation. It should have a clear-cut whistleblower protection policy for its employees. Seventh is the conducting regular internal and external audits. Banks should conduct regular internal and external audits to assess the effectiveness of their fraud prevention and detection systems. Eighth is the establishing data analytics and market intelligence unit. Banks need to establish a dedicated data analytics and market intelligence unit, keeping in view their size, complexity, and the business mix and the risk profile. These four things they have to keep in the mind while establishing the dedicated data analytics and the market intelligence. One is the size, second complexity, third business mix, and the risk profile. So thus by integrating these all methods, 8, bank can significantly have their defenses against the corporate frauds. Now moving to the next segment of my talk, that is what are the measures taken by the Government of India and Reserve Bank of India on the fraud risk management till date. Measures taken by the Government of India and the RBI. First is the RBI. In July 2024, the RBI has issued the Master Direction on Fraud Risk Management, and this Master Direction is a manual for the banks. It is a clear-cut guidelines from the Reserve Bank, that is the banking regulator, to the banks, that how to classify the frauds and what specific initiative they should take to prevent the frauds and to detect the frauds. The purpose of this direction is to sharpen the focus of banks on early fraud detection, ensure timely reporting to both the RBI and law enforcement agencies. And this direction have been issued just in the last year, in the July 24. Second initiative which the RBI has taken so far in this regard is the establishing of the Central Fraud Registry. Central Fraud Registry was established to improve the information sharing and the collaboration. This is a searchable online database built on the fraud monitoring returns filed by the banks and other financial institutions. RBI has advised banks to file the fraud monitoring returns on a regular intervals, and from this they are doing it. Third is in June 2014, in order to keep the database on the large exposure from the point of prevention of fraud, the RBI has established the Central Repository of Information on Large Credits and has advised the banks to submit the information on the bank exposures, including investment exceeding rupees 5 crore and above, to this credit repository on monthly basis. Fourth step which the RBI has taken is recently RBI has advised the banks to integrate the financial fraud risk indicator developed by the DOT, that is Department of Telecommunication, into their system. FRI means fraud risk indicator. Financial fraud risk indicator is a risk-based metric that classifies a mobile number to have been associated with the medium, high or very high risk of the financial fraud. Banks can use this indicator to take the preventive measures in real time, such as declining suspicious transaction, issuing alerts to the customers, and delaying the transaction flagged as the high risk. Now, what the government has taken the measures, the government on its part has issued a specific framework for the timely detection, reporting, and investigation for large value frauds in the public sector banks. Under this framework, banks have been advised to examine any NPA account, that is non-performing account, exceeding rupees 50 crore for potential fraud. They have to examine the account which has turned into the non-performing, exceeding 50 crore for potential fraud. Second, the government has enacted the Fugitive Economic Offenders Act of the 2018 to address the issue of the economic offenders who flee the country, like Vijay Mallya or the Nirav Modi. This landmark legislation is designed to deter the economic offenders from evading justice by remaining outside the jurisdiction of the Indian courts. Finally, to ensure the quality and integrity of the financial audits, the government has established the National Financial Reporting Authority as an independent audit regulator. This body is responsible for enforcing auditing standards, which plays a vital role in preventing the fraud by ensuring that financial statements are transparent and reliable. Together, these Multiple measures by the government and the RBI create a powerful approach to the fraud risk management, strengthening the financial system and holding those accountable for their action. To sum up, to conclude, the corporate fraud in the banking sector is mighty challenge with devastating consequences. It negatively impacts the financial stability, damages reputation, and shatters customer trust. Corporate fraud leads to the massive non-performing assets for the banks that impact their profitability and requires recapitalization. The battle against corporate fraud in the banking sector is ongoing. Corporate fraud prevention and detection requires multi-pronged approach as future leaders and professionals, especially those of you in the forensic science. Your role in safeguarding our financial ecosystem is more critical now than ever. At the end, I express my sincere gratitude to all of you for your patient listening and engaging your presence here today. To the students of NFSU, I wish you all the very best in your academic pursuits and future careers. May you be the generation that brings even greater integrity and security to our financial world. And I once again thank FINCON Organizing Committee for a truly exceptional conference. I wish you all the very best for the remainder of the event. Thank you.